the only thing that we have in crypto that gets close to being able to be a global neutral reserve currency or an asset that is considered neutral and adopted on a global scale is Bitcoin, right? ETH tried to be money and it lost. Bitcoin is a hard asset. It's considered that, it's adopted that way.
All right, everyone, welcome back to the BitcoinYield podcast, which is your #1 place to learn how to put your stack to work. And today I have a fantastic guest, Alexei Zamyatin. I mean, there's a lot to touch on. You guys are building in the space of trying to put BTC to work in a trust minimized way for a long time. Bob is kind of a learning of many of those things to put into a beautiful package. So much to touch on about that, safe bridging, vaults, yield strategies. But before we jump in, for people who don't know you, give us like a 90-second overview of some of your background.
Sure. So I'm Alexei. Nice to meet you. Thanks for having me. I'm the co-founder of BOB, and BOB stands for Build on Bitcoin, but it can stand for other things. It's a fun name. We're ultimately, if I don't talk about tech and if I were to try to explain what we're building to someone who's not as familiar with crypto, the best way to explain it is we're trying to do with Bitcoin what Revolut did for fiat. So we're building the banking infrastructure for BTC to unlock more utility for, in our opinion, the most important asset of our generation. So we want you to be able to hold your Bitcoin securely in a way that you don't have to think about, managing your private key, writing it down, holding a ledger. We want you to be able to trade it, buy it, sell it easily. We want you to be able to take out loans against it, and ideally have a credit card where you can swipe and you can take out a microloan and you can spend without having to sell your Bitcoin. And we're doing that in a decentralized manner as securely as possible, and have been contributors to the space for quite a while. It's been over 10 years for me since I got started, mainly on the research side. I've worked on a variety of topics ranging from merge mining, bridging, layer 2s, payment channels, color coins, what later became known as ordinals. And my co-founder, Dom, so I'm the BTC guy at the company, always have been. My co-founder, Dom, we met during our PhDs at Imperial College. We were the first two people that basically full-time focused on Bitcoin and Ethereum research. He was the first person I met that got into crypto through Ethereum, and that kind of split of work and interest has remained to this date in the company. And under the hood, Bob is a hybrid. We're combining on the tech and product side the best of Bitcoin and Ethereum in terms of security and access to liquidity.
Excellent breakdown. Yeah, this banking infra piece is interesting. And like the Revolut narrative, I do want to double click on that because when you were building Interlay, you were trying to build like a open membership trust minimized bridge, which you've brought some of those lessons over here, and you guys are at the bleeding edge of BitVM as well. But when you guys when I saw the initial conception for Bob, it was pretty interesting. It's like part Ethereum to connect to DeFi, trying to put BTC to work as trust minimized as possible. But now it almost sounds like there's a big push for like CDeFi, which is like front end feels Web 2, back end feels DeFi, and they don't really know what they're using. And so it's almost like neobanks where you don't really realize you're using on-chain. You just feel like you're using a banking app. So like, do you think you're going that way? Or I want to make sure I understand.
I think we have a very strong opinion of how the tech should look like, of how the trust assumptions should look like, and that, power users and institutions should know, and that if you want to, you should be able to check exactly what's going on. But the realization of having spent so much time in the space and working on the tech and, talking to people and building trust minimized tech is that the majority of people don't care. And not because they don't care about security, they just don't have the time to understand. Like, trust is perceived. And I notice this from myself. Like, if I look at a new protocol, well, what's the first thing I'm going to do? Do I look at their code, or do I look at who's backing them and who's running it? I look at who's backing them, who's running it. And like, I assume that somebody else has done the due diligence. And crypto has overcompensated for, we went away from banks where you have no idea what's going on and it's a trust me bro approach, to, let's show the user everything. Let's tell the user that this is Bitcoin, but it's wrapped with this bridge and it's like BTC.OFT XYZ ABCD. And for the user, it's like, well, this is Bitcoin, right? I just want to, and if you compare crypto and DeFi then to centralized exchanges or any other app like Revolut, neobanks, where you now have Bitcoin, they don't tell you this is wrapped. Like, it's implied. Yeah, like, we have your Bitcoin, done. and it's just BTC. And if you go into DeFi, you've got all these wrappers. It's 50 wrappers across 50 different chains. And that's why for institutions and businesses that are moving into crypto and that have users who hold BTC and they want to use BTC now in DeFi, for them, Bitcoin feels risky because it's fragmented, it's unclear, it's not built in a way today that is friendly for institutions. And so the realization is that it has to be DeFi at the core, but it has to be like Web 2 front end. People don't want to write down their passphrase, right? I think one of the major issues we've been facing in crypto is UX. And even Ledger, which is a great product. Ledger is one of our investors, love Ledger. But I still don't like the UX as a retail user when I have to explain to my friends, like, oh, you have to kind of have this ledger. And oh, by the way, blind signing is dangerous because you don't know what you're actually, it's kind of like people are like, yeah, what the hell is going on? Like, this is scary. And what do people then do? They take the ledger and they put it in a bank vault. And it's like, okay, sure, they can do that. But it kind of takes us to a place where it feels risky and people often don't trust themselves with their money, right? I think it's the equivalent of people who will love to self-custody are not always, and I'm exaggerating by far. So please, if you're a self-custody Maxi, this is great. And please don't tear me apart for saying this, but there's a parallel to people who keep cash at home under the pillow or in their own safe, who don't trust the bank with it, right? There is a parallel here to be drawn, and not everybody does that. Like, not everybody wants to keep cash at home. Like, they may just prefer to trust the bank because, well, they think it's more reliable. And we need to allow people to do the same in crypto. We need to allow people to still be in control, but in a way where it feels like they're in control, like they trust themselves. And one of these things, and the tech is there, right? It's just not on Bitcoin. Not yet. Like the tech with smart accounts, it's all there. Social recovery, right? You sign up with your Gmail, your passphrase gets encrypted, uploaded to your Google Drive. Great. You can recover it if you need to, but you could just sign in with Google, with Gmail. Great. Like, that's what people want.
Great answer. There's like 7 can of worms I could open. I mean, I definitely agree. Like, there's been too much of almost like a purity test in Bitcoin. And like, not to say that self-custody or like some of those products are great for some users, but if we're trying to go into mass adopting, it should feel like your bank, especially a neobank where they're more forward-thinking and like tech-focused. But when it comes to your design philosophy, it does seem like a lot of it is like removing clicks, removing friction. Like, one click is a big thing for Bob. And I guess the question is, like, I can see how like you can make it maybe too easy. And this happened with Lava, for example, not to call them out, but like the switch from self-custodial to custodial with that button press, there was not enough friction for what was happening on the back end, for example. So how do you guys think about some of that tension, which is you're serving the future user of just like, I want to feel like a bank and be BTC, but not be so easy that they don't know what's happening?
I think the answer here is transparency. People have complained that Bob is, connected to Ethereum, is EVM, and like is ETH as gas. But that's fine. Like, that's the whole point. We've been transparent. It's part of the design philosophy, and I think it's just important that you're transparent about how the system works, what doesn't work today, and what are the risks you're taking. The last thing we want to do is convince people to, put your Bitcoin, throw them into this yield vault. You're going to make a ton of money and there's no risk. Like that. No, that would be a lie. And the opposite. Like, the goal is to be transparent, but find a balance that you explain to people the risks and you appeal to their general intellect to understand that, this is similar to investing into an ETF or whatever, stock market or whatever on a bank. Like, there are risks. Do your own research. And there's other risks perhaps here than, like somebody could steal your money, and here, ideally, they can't steal, but they could get hacked, right? So yield means risk. I think that's important. In the case of Lava, look, I'm not as familiar. I've tested it. It didn't quite, click for me, although I think the interface is great. And I think, they're going in the direction that crypto should be moving. And again, maybe not use, I don't like picking people out. Like, I think, a lot of people are trying to improve the space. I don't think anyone is doing anything malicious, not on purpose, until we have proof. And then, I think it's just an unlucky case perhaps of miscommunication, right? As you said, like, it wasn't clear enough. And that is a risk, of course, right? Like, if it's not clear enough to users what's going on, people might complain that their assets are moved without their permission. I think the problem is if you sell it as non-custodial and then it isn't, that's where you cross the line. Like, you need to be, people need to know that your funds can be moved. If I tell you, no, I can never move your funds, and then I do it, of course you're going to be upset, right? Like, that's clearly against what I said. if I explain to you, and I get where the tricky bit comes in. If I explain to you like, oh yes, your funds cannot be moved, but in the exception of one of the operators goes down, if you go down the full security proof route, you might lose people. So I definitely see like a challenge in finding a balance between usability and full transparency and security, like not oversharing, but not undersharing. And I don't think there's right or wrong. You're going to have these conflicts no matter what. People will complain that it's too much info, and then people will complain that it's too little info. And I think neobanks are a perfect example, right? Like, did people know that Revolut early on, like that didn't have their own banking license and it was banked like with, the bank account was somebody else? Well, they could find out and check, but it wasn't like shown to them at the front. You could go and read up on it though. So yeah, I think it's something that, crypto will just have to go through and then figure out what works for people. And I'm sure there'll be different teams making different design choices, and they'll attract a different type of user base.
Excellent. I want to ask about one thing Matt Luongo said recently on the timeline that I found interesting was Bitcoiners really want two things. They want access to their equity in the price appreciated Bitcoin, and they want some way to earn yield. Those are like the main two cases. And everything else in crypto is like speculative and highly experimental, and maybe we'll come back to Bitcoin, but like those are the main two. Versus like BTC can be access on chain, do all these things. So I guess I first want to ask, like, do you agree with that framing, and how does that fit with like how you are positioning Bob?
I think it depends on how you look at it. I think it's fair to say that there's a lot of speculation in crypto, and that a lot of it, reflects or matches an online casino. 100%, right? I mean, stock market is also speculation. I think there's a lot of speculation everywhere. People love to speculate. They're going to do it no matter what. I mean, prediction markets are literally the definition of we're speculating, and like, great. I mean, why not? They can be people will do it no matter what. In terms of assets and assets that have value, I mean, how do you define value? Value is assigned to things that people think has value. And I think, the only thing that we have in crypto that gets close to being able to be a global neutral reserve currency, or an asset that is considered neutral and adopted on a global scale, is Bitcoin, right? ETH tried to be money and it lost. And now Solana is eating Ethereum's lunch because it's going for pure compute and fast execution. And Ethereum kind of was like going between and trying to go after Bitcoin and like lost, right? It didn't work. Like ETH isn't considered hard money. Bitcoin is a hard asset. It's considered that, it's adopted that way. And that just means that for somebody coming into crypto, what do people buy? They buy Bitcoin and then maybe something else. And they know BTC and, ETFs were first made for Bitcoin and then for everything else. Does that mean though that, and sorry, there's a cat, apologies. Does that mean that people don't want to do anything else? No, I disagree. Does it mean that every chain and every DeFi app is going to, or is already developing a Bitcoin strategy because everybody's realized that Bitcoin is the main asset of crypto? Yes. So I don't think it's like everything else is trash and only Bitcoin, and then, people will go experiment and come back to BTC. But I do think that every big player has realized that if they want to scale, Bitcoin has to be part of their roadmap.
Okay, let's
Can we pause for 1 second? Sorry, I just need to figure out the cat situation.
The magic of
Just give me
editing.
1 minute.
Yeah.
Sorry for that. I guess you can cut this, right?
Yeah.
Sorry.
The perimeter is secured now. We're good.
Yeah. It's just, it had food and it's thirsty, and now it's getting all like,
You got it.
annoying.
Don't get between a cat and its hunger. All right, let's jump back in. Great answer. I want to pivot into yield specifically. At BitcoinYield, we're trying to break down all the different ways you can earn on your BTC and let you know the trade-offs. There's many design spaces. There's only a few buckets of real ways to earn yield. Like you could do options trading, transaction fees on Lightning. But vaults are a very interesting design space, but they're tricky because they all look the same on the front end. And then there's a spectrum between a black box and like fully transparent with a beautiful dashboard on the other end. And I think you guys have been a pretty strong leader in this case. You were early for sure of making it easy to go into a vault and know what you're getting into. As we unpack it, I want to get in the weeds, but first, if you can give us a preface of like, how do you view vaults as a primitive for earning yield?
I mean, vaults is just infrastructure. It's just a way to, abstract complexity. Like the way we see vaults in our stack, right? At the bottom, we have like with BitVM, we have the execution environment, we have our solver network for swaps. And on top, you have like the middleware, right? We have like intents, which abstracts like actions across chains. So I can swap and I can go into like different positions. And vaults is similar, right? A vault basically tells me, if you deposit your Bitcoin here, this is what's going to happen. And you can earn this yield, and we're going to take your BTC and do certain things with it. And then there's vaults that basically just abstract DeFi actions. So they just chain together DeFi actions, and it's all smart contract based. There's not that many of them though, because, well, you can do so many things. Like its yields are very dynamic. And what people have learned is that you have to intervene. It needs to be actively managed. And most vaults that are actually performing well are actively managed vaults because, well, you can't encode all the possible market conditions into smart contracts. You might need to react. You might need to withdraw deposit capital. There might be an event happening elsewhere outside of your contract's kind of source of not data where you need to react. And then what we're seeing a lot is like curators coming in and managing these vaults, which does give them a lot of power over the funds because, well, sometimes they have to be able to withdraw them, move them around. And more often than not, what these vaults actually are is they are curators taking funds and earning yield off chain or like moving it across chains and basically generating yield, but they have custody over the assets. And it's important to understand that basically vaults are just infra. It's just a wrapper. It's a package where you put your Bitcoin in and then something happens with it. And the something that's happening is really what matters. It's the strategy and who has custody of your Bitcoin and what are the conditions for you getting it back.
Excellent. And this idea of curators, I think of Bitcoin land, this is very foreign. Bitcoin's usually late to these things. They've been going on Base and Morpho for a while. In TradFi, they're a little more used to it. Like you understand the idea of like firms that have reputation and a history, etc. And we had Evgeny on recently from RE7 Labs, RE7 Capital. One thing that's interesting about this topic is when we're talking about yield, there's actually two kind of buckets. There's like mostly linear yield, which might be something like Babylon staking. You lock your BTC, you get like point whatever. And then you get this highly volatile yield, which might come from like volatility trading. And so it's actually hard to pin down even an estimated yield, for example, because it's going to happen. This is your floor and this is your big boom. But on the topic of curators, talk to us more about that, because you've had to pick people to, curate some of these vaults, I'm assuming. So like what goes into that process to even pick a good curator?
I mean, it's not easy, right? It's tricky. And I think, the events 1010 have shown us that, well, it's really not an easy, solution. It's not easy to do because, and I think every creator is in this clinch between risk aversion and managing risk, and at the same time, so much demand and pressure to generate returns. And what happens if there's so much demand for yield, some curators take more risk. And then suddenly you start, as a more conservative curator, you start losing clients, you start losing AUM because, well, they're promising more. And people often don't understand the risks. They don't understand the risk management. And then we've had this, and this is how it always happens, right? People chase yields, they ignore the risks. The players that are more risk averse and conservative, they start losing out. Some cave and follow. And then one of these things blows up, and then, there's a chain reaction. And then even those who are actually more conservative might get hit still just because there's such a massive chain reaction in the market. And it's difficult, right? Because you have to be big enough, I think, and set up in a way that you have like good returns, even if you're more conservative on the yields. And you have to have LPs that value that and are sticky, because otherwise, if you're a new player in the market, well, you got to take a risk. Like, what are you going to offer? Like, if you're a new player in the market, it's very hard to compete with someone who's been around for like a few cycles and has a big LP base that are trusting them. Or if it's a big reputable Web2, like TradFi business that says, we're going to do this now, we're going to take our models on chain and let you basically democratize access to yields. Previously, this was only for funds. Now it's for everybody. And I think that's what happened. Like, what I can say is that there is at least 12 different vault providers that are building BitcoinYield vaults right now. And they're going to go live in the next 6 months. And the question is like, okay, well, who manages these funds properly and what are the risks? And picking a curator is difficult and not easy because you have to spend a lot of time talking to them. But at the end of the day, you just have to rely that they know what they're doing and that they have the user's interest in mind, and that they have enough to lose if they mismanage. And it's also then at the same time up to us to enforce certain standards if we say, okay, you know what, we're gonna, work with you and we're going to build this together, we want certain standards enforced, like proof of reserves for dashboards, proper explanation of the strategy, and just transparency about what these funds are used for, what are the risks to users. Yeah, I mean, we'll see. Like, honestly, I think crypto hasn't quite figured it out yet. I think there was a lot of FUD recently with, curators taking too many risks. Some of it is valid, some of it is unjustified. And yeah, well, I mean, we'll see how the market adapts. But I think the push is for more transparency, more visibility on the strategies, and just more clarity on the risks for users. One thing you can say, right, if you look at the big players in DeFi, like, the ones that have been around, like Aave is in a very comfortable position to not take risk. Not everybody can do that though. So you will always have these cycles where a player comes in and takes risk and they survive, and then they become big enough that they can go conservative. Because Aave was taking risks early on, right? Aave won against Compound, and one of the things they were doing is they were listing more assets. And now they won, and now they're obviously, they're much more in a much more comfortable position to de-risk. And but other lending markets maybe have to be more aggressive to take a market share. And this is the same for any part of crypto. And I think, where there's more yield, there's more risk. And I think honestly, like it's a double-edged sword, because you could blame the curators, but you could also blame the people that were chasing the like very high yields and ignoring the risks. But I think there's always two sides to a coin.
It's a good answer. It also makes me think, like, especially in crypto, we want everything to be in our control, like put it on chain, track it, transparency. And there's a lot of things in vault construction that you can do in your control. But there's this other piece of like Lindy is its own unique benefit, which is that they've proven themselves over time. Like BlackRock has so much money because they're BlackRock and they've been doing it for so long. And so you mentioned that there's a bunch of curators in the pipeline, which would be very interesting. I love this idea of like a marketplace that people can kind of shop around. That's interesting. But to preface, what can people do today on Bob? I want to make sure I have an understanding of what are the current yield options. I had BTC. I want to go deploy on Bob. What's my options today?
I mean, there is we are a bit more careful with what we add, just because it's we built a product called BTC previously, and it was quite popular initially with retail, but it wasn't as popular with institutions because they could just do it. They didn't need a vault for it, and it turned out it was it's just painful to maintain if it doesn't hit a certain size, and the costs tend to start growing. And we took a learning and we shut it down. And basically, relaunching vaults with just a different approach of, okay, we work with curators, we go and we test it. Like, is there interest for this strategy? Are there enough LPs or high net worth individuals that will put their money in? Because if they do it, then, we're quite confident that it will start scaling. If they don't touch it, well, there's always retail there's a lot of those users that will go, and we have a pretty good distribution channel. But you want to make sure, and this is additional validation, is a fund that's more educated, understands the market better, willing to put money in? If yes, that's a pretty good signal that, okay, this kind of works. Right now, we have two strategies that are basically LSTs, still built on Babylon, that obviously where yields have come down because it hasn't kind of developed as quickly as we all hoped. And then we have two vaults that are done together with Solve. There's a Solve the Jupiter vault, which is specifically basis trading on Jupiter and Solana. And there's another vault that is BTC Plus, which is basically an abstraction. It's more retail focused, and I'm sure Solve can explain this better. But it's a mix of different strategies. So you have commingling of strategies, which not everybody likes, and not all institutions like that. It's more a retail facing product where you say, okay, these guys have been doing this for a while. They have a lot of assets under management. They, seem to have these strategies under control. I can see where the assets are. I can check what the strategies are doing. I have a prediction of the yield range based on past performance, but of course, past performance is not a guarantee for future performance. And, it's a nice mix of different trading strategies, basically. But it's a vault that does trading, right? So it's a strategy that uses Bitcoin for trading. And you have to be aware that there might be risks, just like with every other vault. And other strategies that we're building out right now are more often, there's different ways to do it, right? There are Bitcoin denominated yields where you go and use options and so on. And then there are a lot of strategies basically just use Bitcoin as entry point. You use Bitcoin, you borrow stables at good rates, and then you earn yield on the stable coins, and you basically make arbitrage on, okay, I can get more yield on the stable coin than I'm paying to borrow it. And including the Bitcoin loan to value ratio. And a lot of these things happen off chain. And of course, like there are on-chain yield strategies as well, where you go and you look for the best yields across different chains in DeFi. And of course, often these yields are subsidized. There's tokens emitted on top because people want liquidity. And, recently, Bitcoin price is down now, but generally the last few months and the next couple of months, if not years, it's going to be high season for Bitcoin liquidity. Everybody wants it. There's big chains paying for it, even if it's not necessarily sustainable, but they're big treasuries and they're trying to get more liquidity. So a lot of these vaults are basically what we've seen in the market. They just go and they they deploy into low risk strategies, but there is good yields because there's a kicker paid on top. Is it sustainable over like a course of 2-3 years? Probably not. But then again, there's always a new chain launching. It's basically, it's a viable strategy at this point in crypto, and people are going to do it no matter what. So, well, why not make it easier? And if you're aware that this thing will deploy to different chains and you're accepting the risk, well, here you are. If you're going to do this manually, well, okay, might as well just let somebody do it who really knows how to navigate this. And you're paying a premium for not doing this yourself. But I think it's important to highlight that today, as of right now, vaults are rarely DeFi vaults, specifically for Bitcoin. And the reason is that the yields on BTC generally are quite low, right? The risk-free return rate on Bitcoin is like sub 10 bips. It's lower. It's like 1 bip probably on average, maybe like 1 to 10 bips. Because you can supply into lending and as a wrapped asset and then hope that people borrow it a little bit. And generally people don't. Not yet. When people start borrowing BTC from lending is when they want to leverage up. They want to leverage up on some yield bearing strategies. So what we've seen with Ethereum, where you have ETH LSTs, right? They give you staking rewards, people started looping because it's lower risk because you don't have risk of liquidation unless it depegs, unless the protocol breaks. And so we've seen in Ethereum is essentially people borrow ETH to stake it and use the staked ETH as collateral to borrow more ETH, and they go leveraged on the staking position. And the risk is, well, getting slashed. But the interesting part is in that case that if they get slashed, they lose the money is gone anyway, no matter if you're leveraged or not. The risk is not from the price changing, the price depegging because ST increased or decreased in price. It's it breaks if the protocol breaks. And we've seen the demand for this in Bitcoin as well, except that there are not many LSTs that actually generate attractive yield yet. For this, you need the LST to have a ton of liquidity. And Babylon LSTs had a lot of liquidity, but right now the yields, they're not quite high yet because, well, security is cheap and, you need protocols like BOB who will be willing to pay for stake Bitcoin to actually generate lots of revenue to share that back. And then you have this issue where that only works if a lot of the LSTs deploy first. And you have this cat and mouse problem where you need to bootstrap activity before you can start kind of hitting this flywheel effect where more LSTs come because there's more staking rewards and it contributes to more liquidity, more fees, and so on. And as a result, right now, the risk return rate on Bitcoin is quite low. And the interesting part is that it only will go up if there's enough people that are willing to put Bitcoin into high risk strategies, which are obviously all tokenized. Vaults are usually tokenized, so you get the tokenized position that you can use as collateral. But using it as collateral in a lending market usually only works if there's enough liquidity, because you need to open a DEX pool, you need to have enough liquidity to ensure liquidations. So it only works after a certain threshold. If you only have $10 million in a vault, nobody's going to accept it as collateral. You have to hit the 100 mil, 200 mil plus size to actually, be able to borrow against it and then go and leverage up. Because what you do is you get a lending protocol to do due diligence, accept it, or a curator to accept and run a lending market, for example, on Morph, or you get Avid to accept it, which is where the threshold is much higher usually. And then you can borrow BTC to put it into the vault and to leverage up that way. And the interesting part is that the chicken and egg problem here is that that's how you actually get higher returns on Bitcoin and lending on the risk return rate, because people are borrowing BTC that's in lending because they can get more yield on it. And that's when the risk averse people get more yield from supplying Bitcoin into lending, because people who want to take the risk, they're generating yields and they're kind of leveraging up. So that's what's happening on Ethereum. That's what's happening in proof of stake networks. And that's what eventually will happen on Bitcoin, with a subtle difference that Bitcoin has no native yield. Bitcoin doesn't emit tokens for staking. It emits tokens for mining, and you can tokenize hash rate. And we see this coming back as well, but it's not as popular because the risk package there is just different. You buy ETH, you stake it, if the protocol breaks, ETH is okay, ETH breaks. With Bitcoin mining, it's different. You buy into the risk of the enterprise of like the actual data center or like with the mining rigs in that geographical location, which, may be legal today, but might be illegal tomorrow, or the electricity price might skyrocket. So the risk profile is different to just staking. But having said all this, and I'm going to pause my monologue here, we will see more BitcoinYield strategies come online with tokenizing hash rate, off-chain credit strategies, basis trading, options, all sorts of things that people are already doing on centralized exchanges be tokenized on-chain, and eventually that liquidity inflow will help us bootstrap more on-chain yield sources from on-chain perp dexes, from on-chain options markets, that eventually, hopefully one day, we can stop relying on off-chain trading and actually do this on-chain. And then the definition of on-chain is obviously vague, because do you consider hyperliquid being on-chain or off-chain, right? Like, it's not super clear of like, where do you draw the line?
First, you're making my job extremely easy, so thank you. I took a ton of notes. Instead of opening any of these, I'm going to refer people to the show notes, because I think you actually did really good explanations of a lot of these. So I'll have just like kind of like check marks people can go learn more on. I'd love to, we're at 34 minutes and maybe a few more questions. One thing that you guys are working on that looks super interesting is this liquidation engine. And cool name, not entirely sure what's happening behind the scenes. Let's start to unpack this. So first, give us an overview of what is this thing you're working on.
So the liquidation engine is an extension or an addition to native Bitcoin vaults that are powered by BitVM. So what is that? Like, what is BitVM? I'm not going to go there, but think of it as the holy grail of Bitcoin DeFi, right? What everybody wants is to have Bitcoin, deposit it into a vault. That UTXO is mine, right? And I should get it back if I repay my loan. And I don't want commingling of funds with other people. I, don't want tainted funds. I want to get exactly that Bitcoin back if I repay my loan. That's what you want. And you want this to be enforced programmatically on Bitcoin. So you don't want a single person, a group of people, a custodian to be the one who you trust. Because today, how these things, if you want to accept native Bitcoin deposits, how it works is either you go and wrap it and then use DeFi, or, and we've seen this with DLCs, which usually is like a mix of custodial, but generally you have a group of signers that act as attesters, right? So they take custody, and you might be a signer in there, and your counterparty might be a signer. It's like a tri-party agreement in a sense. Me and you, for example, if I'm borrowing stables from you, me and you would trust and agree both that this third party, whether it's a single or a group of people, will check and enforce the correct closure of the loan agreement, right? So if I repaid, I get my Bitcoin back. If I didn't repay, I defaulted or I get liquidated, well, you get my Bitcoin. That's what we kind of want. But we want this without this committee. We want this to be programmatically enforced. And BitVM allows us to do that with some limitations, like with all technical things, there's no perfect solution, but it gets to a point where it's arguably native. It's native in the same way that ETH on Arbitrum is called ETH. It's not called ARB ETH. We consider ETH on Arbitrum native because, well, you can always get it back with fraud proofs. Same concept here, right? So that's why we feel comfortable calling this native Bitcoin lending, right? Now, the problem with this has always been that, well, we can figure out custody and we can figure out a way to trigger liquidations. So we can verify in BitVM that, I defaulted. Now, of course, between us, we obviously know that you need an oracle somewhere, like Chainlink is somewhere in the mix anyway. But let's, ignore that problem for now, because the oracle problem is not going to get solved. We want data from centralized exchanges as well, because, DeFi liquidity is too shallow often and can be manipulated. So let's ignore the oracle problem. But let's say, we verify on Bitcoin that, yes, I repaid or didn't repay the loan. That's all programmatically done. Great. Now, the problem with BitVM is that it is just slow. Like, the way optimistic things work or fraud proofs work is I will go and say, hey, I want to take my Bitcoin out. I repaid the loan. And then you have time to challenge that. Now, giving you only 5 minutes might not be fair. What if you're like at a dinner and, or your server's down and suddenly I'm tricking you and I'm attacking your server with like a data analysis service attack just to cover the time when I'm withdrawing. So usually these withdrawal periods are longer. On Ethereum, for example, they used to be a week. Now they're going down as the systems mature and the watchtowers and like the monitoring systems mature. we're going down to 3, and then I think there's discussions on Ethereum to go down to a day. With BitVM, we're still fresh. So you usually have longer periods of like 2 weeks or 1 week, 1 to 2 weeks to kind of process the withdrawal. So that means that I withdraw Bitcoin and then you have a week to challenge me and then we resolve it. This is good for you, right? So you can get, I can cheat, I can steal. But it's also bad in a setting where you need liquidations if there's a bank run. So think now of Aave. Aave accepts this vault, that Bitcoin that's in these vaults, as collateral. Great, we can borrow stables and so on. But what if the Bitcoin price tanks? Like we have a black swan event, it just goes down, bank run. People are getting liquidated. Now, what you want to do is you want the liquidators to come in and liquidate the positions. But what the liquidators usually do is they have capital, the market makers want, they have capital, they want to do USDC in, USDC out, right? And then do the next thing, or they might need to cycle, they might need to take out a flash loan because the position's bigger. It needs to go fast. Well, and if you say, well, wait a second, you're going to get Bitcoin, but it's going to take a week until you definitely have it because there's a challenge period. Yeah, that doesn't work, right? That just breaks liquidations. It makes them non-atomic. And lending markets like Aave want atomic liquidations. I liquidate you instantly. You're under the LTV ratio of liquidations, you're gone, right? I've recovered the protocol, there's no bad debt, and we're done. You knew the risks, I recovered the protocol safety, I protected lenders. And now I'm coming to the actual, the liquidation engine, and the credit goes to Dom, my co-founder, for coming up with this. So the liquidation engine aims to solve this problem and make it actually viable for lending protocols on Ethereum to accept BitVM vaults as collateral. And it addresses a specific problem of let's make liquidations fast. And it comes with trade-offs, and there's different approaches that you can take depending how fast you want it. But then one of them, the fastest approach, is to pair this with an existing bridge. And that bridge could be, again, a BitVM bridge or a centralized wrapper, doesn't matter, it's a temporary thing that basically will accept that risk, that timing delay. It's not even a risk, it's a delay, and they will accept that delay and deliver you the Bitcoin immediately. So you basically set up a counterparty in a way where, look, and it can be done as a swap, but generally swaps, it's expensive to maintain liquidity to be ready for like moving in 100 Bitcoin at once or 1,000 Bitcoin at once. So usually this works better with a bridge, but the gist of it is, if I'm liquidating you and I'm going to get Bitcoin on Bitcoin in a week and I can prove it, I find someone, a counterparty, that will say, hey, look, I'm going to give you wrap BTC or even maybe stables on Ethereum or BOB right now, so you can continue liquidations and that you're done and you can continue kind of trading in the markets. And now I'm going to accept the delay on my side and I'm going to charge you a bit for it. And that's basically how it works. And like you can integrate this with a wrapped asset bridge, like a Bitcoin bridge that maybe is centralized or decentralized, but it has pre-minting rights. So it will say, well, look, we know this thing is coming in a week. We're definitely going to get it. Like, there's no way this is going to get spent by anybody else. We're going to pre-mint the liquidity now because we don't care. We're going to get it anyway, but you can continue liquidating in the market and make sure that the lending market is safe. So that's kind of the things we're looking at right now. You'll see that these are very practical problems. We're way past the question of like, does it work with BitVM? It's rather, how do we plug this into a lending market that makes the big lending markets on DeFi comfortable? And that's basically what this liquidation engine does. It makes sure, and that like in different ways, either is like market makers, there's a market for it for the atomic swaps, or there's a bridge integration that you can get these liquidations done atomically and fast so that lending markets can actually, maintain integrity and not be affected by these delays on Bitcoin.
I wanna rehash this to make sure that I understand and that the user does, because this is actually very, very interesting. So a couple things to tease out. One, there's this term non-custodial, which if you're in the weeds, you kind of understand it. So it basically means that no one can move your funds besides you. If you have the private key, you can move it around. You need to be careful about how people market this. If you look at Morpho, for example, they'll say non-custodial, Bitcoin, whatever. But it's assuming, okay, I'm already cool with Coinbase and CBBTC. So it's moved from my BTC is now permissioned partially, but once it's in that place, it's non-custodial. Only I control it.
The wrapper is non-custodial, but the underlying BTC is actually custodied.
Exactly. And so what BitVM does is starts to push that non-custodial back further down the stack, closer to the L1, where you have some say in your redemption rights if things go sideways, which is this challenge thing you're talking about. Current big issue with BitVM is, as you mentioned, there's a time aspect of that, which has two pieces of it. One is you have to be aware of it. So, you're not out and about and you're not hitting the button to, stake your claim and provide your proof. And then two, DeFi moves fast and is always on. So you need to manage these positions quickly. Then we go into connecting Bitcoin to ETH is interesting because ETH has the deepest liquidity. So with something like this, you can lock BTC in this BitVM bridge, but get access to the deep lending markets on ETH, for example. And then this last piece is you put interested parties in to almost front the money because they know based on how the protocol works, they'll get the money eventually. So they can take their piece, you get your money immediately, and everyone's kind of happy. Is that a decent breakdown?
Yes. And then these parties could be either market makers or basically LPs that, just basically they borrow you, they lend out, or it's a swap with a delay, or it's integrated into existing bridges, which basically say, okay, well, it could be integrated into an existing BitVM bridge, right? Like you could have vaults are generally not wrappers, right? You abstract, you don't wrap. It's like Bitcoin is on Bitcoin. You have the same UTX, so you don't commingle funds. With bridges, it's pooled, right? Like if you put in one Bitcoin, you're not necessarily going to get exactly that UTX. So like if the moment you pool it in your ERC20, it's commingled. So if somebody with sanctioned funds does get in, people that's where institutions kind of are worried. And the vaults are kind of like, okay, your UTX, so that's your thing. You're going to get exactly the same Bitcoin out. But then in case of liquidations, if you say, well, I'm going to borrow against it, your fallback could be, well, in the worst case scenario, I'm losing my Bitcoin, but the liquidator is going to get the BTC that goes through the BitVM fully fungible bridge. And that bridge is going to accept this delayed deposit and going to mint new wrap Bitcoin immediately so you can proceed with liquidations. There's a lot of technicalities in here, but the gist of it is exactly what you said. Great asset. BitVM, super secure, but slow. DeFi is fast. We kind of need to bridge that gap. And there's some additional trust assumptions, but they only get triggered in case of a bank run. And that's really what you want to prepare for. Like in a bank run, having a temporary trust assumption in some other bridge or a multisig is definitely better than having the whole stack just get liquidated completely.
Excellent. Okay, this is super interesting. The liquidation part is really a proxy for solving the peg out problem. So a bunch of stuff happens somewhere, and then you make sure that programmatically as possible, the BTC goes back to where it's supposed to. But on the flip side, on the input side, you started by saying you can think of them kind of like an extension of vaults, which again, the definition we're using is you put it into a box and then it can go do things. So to make sure I'm clear, this could be used for many things. It could be used for Bitcoin-backed loan. It could be used for yield strategies. It could be used for is the input device is what it is, and then what you do on the other side of it, there's a huge design space. Is that how extendable it is?
Yeah. So the way we kind of see it is this is like the OP stack for Bitcoin vaults, right? And you can have different trust assumptions, right? Like you can build this without BitVM, right? And that's how it often works today, where you have like a custodian and you have an arbitrage committee, and they will interface and make sure that certain conditions are met. And that's already done in practice, right? There are existing solutions that do that. Tri-party agreements are as old as Bitcoin, right? People wanted to take out loans and need somebody in the middle, a trusted intermediary that enforces the loan gets repaid. Big custodians like Anchorage and companies like Unchained have been making money from this for ages. What we're doing now is we're saying, you can do this on-chain, you can generalize this and not use it only for loans, but use it for whatever, on-chain yield vaults, other strategies on-chain, and just, benefit from the composability of tokenizing that and letting people do whatever they want with it. And two, then you automate this with BitVM and remove the intermediate, but you really push it to the point where it's as you said nicely, right? You kind of push the lack of custody or the trust assumptions. You move them from, there's a wrapper and the wrapper itself is now, non-custodial and it's in your own wallet, but the underlying Bitcoin on BTC isn't. You push that down the stack. And I like your explanation actually. And you make sure that the Bitcoin itself that's locked in the vault is actually programmatically secured.
Excellent. Okay. I want to bring this to a close. We covered a lot of interesting things. This does feel like a step function, kind of like forward in trust minimize for putting a BTC to work. So very intrigued by that. For people that are excited by this, when soon is the classic question. Like what's in the near term roadmap? When can they play with some of this stuff? What's kind of coming in the next like 6 to 12 months as he brings to a close?
Well, BitVM is live on testnet, and you have operators, bigger institutions running it already, getting familiar, and we help them get educated on BitVM, try to convince them of like, look, this is just like MPC was the evolution to multisigs, BitVM is the evolution to MPC. Like this is what we're going to be using in a few years for all Bitcoin custody and DeFi. Be first, like, so you can actually build this into a product and like be the leader in that space. But obviously the question you get is like, well, how do we make money on this? Why should I run this? And this is something that the BitVM community has struggled for a bit, like with any new tech, like, okay, why should they run this? And why should they switch? And that's where native lending is perfect. Like that's the use case. Like, and that's what we're doing right now is we're not just taking BitVM to market as a bridge wrapper. Because like people, yeah, it's nice, it's more secure, but are they going to pay more for it? No. Right? That's the thing. Like people are not going to pay more for a BitVM bridge, not much more than like for RapidEC or TBDC, even though BitVM is more secure. They're not. People are picky. Like they want security, but they want it cheap. It doesn't always work. If you plug it into lending, you actually get a very clear use case and you're paying for the product. Like you're paying to get exactly that Bitcoin back and to take out a loan and as securely as possible. And so what we'll see basically rolling out in Q1 is like a first version of this. I'm not sure if it'll be fully BitVM integrated on day one. It's definitely without doubt going to have training wheels. Before, you want to make sure like you find the right balance. The way we approach things is we work with the same institutions that users already trust and we convince them to run BitVM. And now your trust assumption is, oh, wait, okay, these guys are not going to steal my Bitcoin anyway, because look, they could have already stolen it from all these other services I've been using with them. But if they tried, I have BitVM here. And for the more security-focused people who are really like full on being non-custodial, like, okay, these guys, I don't trust them, but yeah, there's BitVM. So you kind of appeal to both groups, and it's a nice way to get it started. So to answer your question, when soon we'll see first things on Mainnet in Q1 most likely, and then with a gradual rollout and taking off the training wheels as we progress. But you really want to be careful here to, it's new tech. And if you look at how long ETH took to go from, we have a multi-sig sidechain to now it's a ZK rollup, 5-6 years. We're like a year in since BitVM was really in a state where you could build it. I think we're moving very fast, but as fast as you can move when the product is security.
Excellent. All right, so Q1 looking like it might be BitVM season. Very, very exciting.
Definitely with training wheels, like, it's going to be BitVM and like a, asterisk, like, yeah, but, there's like training wheels. Just I think the way to see it is like, stage 0, 1, 2 on rollups. And I know L2 beat now is upgraded to stage 0. So if you're not stage 0, you're not a rollup even. So you're like a side chain, but similar rollup. You start with something that's maybe not even BitVM, and then you add stuff, but it's still with training wheels, and you really want to get to stage 2. And people might often ask, well, why would people, go to stage 2 if they have a product that works with like stage 0? Well, Ethereum is proof, right? Everybody wants that. The expectation is that you decentralize, and protocols will start making decisions of where they deploy based on whether you have reached stage 1 or 2 or have not. And institutions will look at that. And for example, Aave, for their GHO stablecoin, they will look exactly at what's your security model, and they will not deploy if you've not reached a certain stage. So there is this push from protocols in the industry to move to more secure solutions, and you can kind of, go through these stages, but eventually at a certain point, you're going to have to upgrade. And if you don't, you're going to fall behind and people will switch.
And that's a good thing to double click on, which is that like even if it's a better solution, it's foolish to just go straight into like $1 billion in the protocol before it's been battle tested. So you got to kind of do these in stages and let the kind of like Lindy effect and the trust in the protocol really come to fruition. So that's excellent. All right, well that's all the questions I have. We covered a ton. Any closing thoughts you want to impart to the audience?
Well, I mean, if you want to learn more about vaults, Bitcoin yields, definitely check out Bob. You can find it on our website, gobob.xyz. It's short for Go Build on Bitcoin. And yeah, I mean, help us bring banking to Bitcoin, or build the bank of Bitcoin, and, go into the race against all the TradFi banks trying to capture BTC and, put forward a more decentralized option.
Love it. Love it. All right, Alexei, man, thank you. Thank you for coming on the pod.
Thanks for having me. Bye-bye.